Welcome back, everyone, to another High Yield Explainer. Today, we're zeroing in on the essential ethical foundations and dilemmas that you absolutely need to master, not just to crush your exam, but to protect your entire future career. Look, I know exactly how grueling this prep can be, so we're going to jump right in and efficiently break down the theoretical frameworks, the historical precedents, and the modern-day pitfalls that literally define the accounting profession. Let's do this. Here's our quick roadmap for today's explainer. We'll start with the foundations of accounting ethics, move into common ethical dilemmas, look at some real-world case studies, and wrap up with mitigating ethical risks. Kicking things off with Section 1, Foundations of Accounting Ethics, where we'll establish the baseline rules. Now, to really grasp the ethical traps that catch new accountants off guard, we've got to talk about the sheer scale of the problem. You know, it's easy to think of accounting ethics as just this dry, academic exercise you memorize for a test. But get this, the Association of Certified Fraud Examiners estimates that organizations lose a staggering 5% of their annual revenues to fraud every single year. 5%. That's a massive economic drain, and it highlights exactly why sticking to the rules isn't just about taking the moral high ground. It's about keeping businesses alive and functioning. And this fight for integrity, it's not some modern invention. It goes way, way back. We're talking ancient Mesopotamian scribes with the Code of Hammurabi around 1754 BCE laying down the law on honesty in commercial transactions. Jump forward to the 15th century, and you've got Luca Pacioli introducing double-entry bookkeeping, demanding accuracy and balance. But as you might guess, it took a massive crisis to force actual modern regulation. The 1929 stock market crash was the wake-up call that proved unequivocally that without strict rules, companies will absolutely manipulate their numbers to look way more profitable than they actually are. And that led directly to the formalization of our generally accepted accounting principles, or GAAP. Okay, for your exam, you need to be able to confidently contrast these baseline principles. First up, the going concern assumption. This basically assumes a business is going to stick around for the foreseeable future, meaning its asset values and capacity to create value are expected to endure. Contrast that with the matching principle, which is literally the engine of accrual accounting. It insists, no exceptions, that expenses must be recorded in the exact same period as their corresponding revenues. Why? Because it creates a true cause and effect relationship. It stops companies from artificially hiding costs to look like financial geniuses in Q1, only to completely crash in Q2. So, tying right into that is the conservatism principle, sometimes called the prudence concept. Think of this as your protective buffer. It demands that when you face uncertainty, and trust me, out in the field, you're going to face a ton of it, you must never, ever overstate a company's financial position. You cannot accelerate unearned revenue. It means you record expenses and losses as soon as they're reasonably possible, but you wait to record revenues and gains until they are absolutely certain. The golden rule here, it is always less harmful to understate a financial position than to artificially pump it up. Moving on to Section 2, Common Ethical Dilemmas, focusing on the real-world pitfalls of the profession. All right, let's pivot from the rules themselves to the messy reality of what happens when those rules are intentionally broken. This brings us to the absolute highest yield section for your test prep. Notice the stark contrast we're looking at here. While the conservatism principle demands caution, prudence, and deferring to lower asset values, earnings management aggressively breaks those boundaries to paint this highly optimized, artificial picture for the public. Basically, it's the difference between reflecting reality and just manufacturing a convenient narrative. Seriously, treat this definition like a flashcard because you are absolutely going to be tested on it. Earnings management is the deliberate manipulation of financial results to either meet analyst expectations or achieve a specific desired outcome, like securing a huge loan. And let's be clear, this is almost never an accidental clerical error. We're talking calculated tactics, things like income smoothing to make volatile, choppy profits look nice and stable, or creating cookie jar reserves to quietly shift profits from the really good quarters into the bad ones. It completely distorts how investors perceive a company's actual health, and it undermines the whole efficiency of the market. Next up on our must-know definitions, conflicts of interest. This happens when accounting professionals find themselves torn between competing loyalties or interests that basically compromise their objectivity and independence. I mean, imagine you've got a close personal relationship with a client, or maybe a direct financial stake in the company you're supposed to be auditing, or maybe you're just under intense, crushing pressure from your firm's partners to keep a really lucrative account happy. In every single one of those scenarios, your objective judgment is totally on the line. Navigating this means you have to prioritize your professional responsibilities over any personal gain, every single time. And finally, the most severe violation on the spectrum, financial reporting fraud. This isn't just bending the rules, it's outright deliberate deception. It is the intentional misrepresentation or manipulation of financial information, explicitly designed to trick stakeholders and falsely inflate how the organization is performing. And as we're about to see, this is definitely not a victimless crime. It devastates investors, it wipes out employee pensions, and it can literally rock the broader economy. That brings us to Section 3, Real-World Case Studies, where we look at the catastrophic fallout. Now, you might be asking, why does all this matter outside of just memorizing the textbook? Because failing to stick to these exact principles literally collapses global markets. Look back at two of the darkest moments in modern financial history. The Enron scandal in 2001 showed us exactly what happens when widespread financial manipulation becomes actual corporate strategy. It brought down a massive energy titan and sparked sweeping regulatory reform. Then you've got the Lehman Brothers collapse in 2008, which triggered a global financial meltdown. That was driven by incredibly aggressive, deceptive accounting and a complete absence of ethical oversight. Billions of dollars just gone because fundamental accounting ethics were ignored. But here's the craziest part. Despite those historic, catastrophic disasters, the data shows we are still incredibly vulnerable. A recent Deloitte survey revealed that 47% of executives, nearly half, actually believe their own organizations are unprepared to manage ethical risks today. Think about that. Almost half of corporate leaders look at their own internal structures and basically admit, yeah, we aren't ready to catch the next Enron. That is a massive gap in the market, and candidly, it's exactly the gap that you are training to fill. And that leads perfectly into Section 4, Mitigating Ethical Risks, focusing on the actionable solutions. So how do we actually fix this vulnerability out in the real world? And more importantly for you, how will you be tested on these solutions? Well, here's the step-by-step framework for keeping organizations and accountants honest. First, an organization has got to consistently identify its vulnerabilities through regular risk assessments. Second, you build strict internal controls. Third, you foster ethical leadership that sets a no-compromise tone right from the top. And fourth, you absolutely have to implement safe whistleblower channels so people can flag unethical behavior without being terrified of retaliation. Let's zoom in on those internal controls for a second, because this is prime exam material. You need to know that segregating duties, meaning the person who authorizes a payment is definitely not the same person signing the check, along with requiring dual authorization processes, are your absolute best, most practical defenses. They protect you against simple, accidental clerical errors, but also against deliberate, coordinated fraud. Beyond just the controls, ethical leadership isn't just about slapping some rules into an employee handbook. It's about aligning what people are actually paid to do with what they are expected to do ethically. Your corporate incentive structures have to actively reward integrity. It's actually fascinating to look at this through the lens of different cultures. For example, the Indian accounting profession places a huge emphasis on the dharmic concept of satya, or truthfulness, which encourages strict adherence to ethics even when the temptation to cheat is massive. The main takeaway? You can't just reward people for hitting financial targets at any cost. You have to reward the ethical process itself. As we wrap up this explainer, I want to leave you with a final, slightly provocative thought. You've learned the principles today, you've memorized the definitions, and you've seen the catastrophic consequences when things go wrong. But when you finally get out there in the real world, sitting at your desk, and you're facing incredible pressure from a boss or a major client to compromise just a little bit,